Hi everyone. Today I'm gonna start talking about interest rates. So I really wanted to share this topic because I thought it's a very important topic for investing overall, and I would say that that's what dictates where you invest and what you do with your money. And like I don't think many people understand it well, and I'd like to just explain it and just let you know how everything works related to interest rates. So let's get on it then. So what is interest rate? As put it simply, it's a price that you pay to borrow money. As simple as like when you make a loan, um, you will actually pay an interest rate, and that interest rate will be the cost of just borrowing that money on top of paying it back. So when you create a new loan, the money is newly created, so it's not an existing part of the money supply, but it is something added on top. So here is an example. Simply, if you borrow $600,000 and the interest rate is at 5%, you will have to pay $30,000. So that doesn't include paying it back, but just to maintain that loan at this price. Here is a chart that describes the interest rate since the 1960s. So this is the US interest rate. As you can see, from the 1960s to the 1980s, the interest rate rise significantly. From the 80s to 2000, it dropped in the past like 40 years, and recently in the past 2 years it started rising. So those interest rates are not stable, and they change significantly from one period to another, which affects the whole economy, which affects sometimes assets, how people think as well. It's all related to this interest rate, and I think it has a way more important part of our lives than we actually realize. So I'm gonna go a little bit deeper next to explain um, what it is. So now we're gonna talk about what causes interest rate to reduce or rise. So in this example, I will try to make it as simple as possible. It is a little bit more complex than that, but this is just to give you a perspective on how things move. So the printing of money will affect the currency, which will lead eventually to a high inflation, which means that if you print a lot of money in like a short amount of time, it will actually increase the money supply. So which simply means that there's too much money, and then every asset will be chased. So people will just chase asset, and because they are limited, like for example, there's limited amount of house, there's limited amount of businesses, so the money will chase all that, and then simply services and everything will cost more than it used to. And the only way to lower inflation is to lift interest rates, which means that you have to increase interest rate to up to a point where inflation doesn't grow anymore, which can be sometimes very high, like in the 80s, where it had to get to nearly 15% or over from my memory, which was higher than what the inflation was. And that's what's important to understand, is that the interest rate need to beat inflation to incentivize people to save money instead of like spending it, which will at the end slow the inflation, and then we can finally start lowering interest rate for more average scenarios, instead of being in extreme situations like that. 15% was really high. So yeah, that's it. In this chart, I just oversimplified the period with the interest rate since the 1960s up to now. And I wanted to simply give two scenarios. So one scenario with a high interest rate in blue and one scenario in a low interest rate in orange. So we will give example on each of them and then explain like the differences of cost of borrowing. So the two examples there will be the 2%, which was before in orange, and then the 10%, which is in blue color from the previous chart. And so the first example of the 2% interest rate means that it's a low interest rate. So if you borrow $500,000, it will cost you $10,000 at 2%. And over, like, let's say you're making 100,000 and that's the average salary, then that means it will only cost you 10%. So that means like it's very low, like the cost of housing with the salary you have. On the contrary, if the interest rate is high, then like, and for example 10% interest rate on a $500,000 house, that will be 50,000, which is 50% of the salary. So in this situation, it's very high, and that means that people can't keep paying at that price. So in the next example, I will explain what happened, because in extreme cases become the average, and then I will explain what most likely happened to assets because of those situations. So in the blue little box, we can see the examples previously of 2% and 10%. Apologies for the 3% interest rate, is supposed to be 2%. So yeah, so we're gonna explain from there what asset prices do when interest rates goes higher, goes lower, and all that. So they will be directly impacted on assets. So if the interest rates is high, the asset prices will automatically go lower, and if interest rate is low, then the assets will be costing more. And so if an example from the previous case, the house at 500,000, and that represent 50% of the salary. So example 2 will most likely to go down to 25% because it's a more reasonable cost of housing. So it should get to 250,000 on an average middle environment. And $500,000 house, if the like it represents 10% of the salary, which means that it will be so at an average of 25%, that means that the cost of the house will go to $1.25 million. And this example, the second one, is what we seeing up to 2020, 2021, to up to even today, when interest rates just started rising, but they still been very low in the past few years, which means the house price are very high. And now something to be careful of is that inflation like will actually correct those prices. So that means that even if the house cost 500,000, if the inflation goes 10% every year, it means that even if it were to drop 50%, but this, like, everything rise, even the salary, and salary get to 200,000, for example, on average, instead of 100,000, that means that the house price will just not move. It will stay 500,000, but everything else will catch up to it. That's the only way. So now we're going to talk about low interest rates. So it is much easier to lend money when the interest rate is lower, so the bank won't require as much, so you have to prove your salary and basic requirements, but nothing extensive. Then the business are booming, the money is flowing, and it's easy for businesses to create new product, new services, easy to employment and everything around that. The lower interest rates though tend towards the end to create a little bit like of a frenzy and craziness where people will pay anything for something that doesn't even bring any money. Like companies that don't actually make any money will tend to still have very high valuation, which still is happening up to now, but it starts to slowly fade because it takes time for the environment to change, sometimes even like years, like to just see a significant change. On the contrary, when the interest rate is high, it is much harder to borrow money. So banks will require more, like from you. They will be way more cautious because they're more concerned that you will not be able to pay back. When the interest rate is high, it means that it will cost more for everything to be borrowed. So that means you have to pay back a lot more, and banks will be wary of that. The business will most likely struggle to stay afloat, so they will have to ideally have great assets and already spend on infrastructure to be able to take advantage of that, and then having low cost, and then be able to really make like a lot more money. But if they have to spend on infrastructure, it will cost more in the future, which means that like it will make them in trouble, possibly. And like the more interest rate goes higher, and the more it will impact on valuations as well. So a business that makes money will still be cost less on the higher interest rate than it is on the lower interest rate. So valuation tend to go lower. For example, the PE ratio is most likely to go lower when interest rate is high. So to conclude, what I wanted to explain is simply that interest rate is very important in our daily life, and it could in good periods make us rich, like it could make us very poor if we buy, for example, a house in the wrong timing, or if we put the money in some businesses at some period will be very different than others. And you have to be always wary of that when you invest in the long run, is to make sure where the interest rate is, and invest in the right industries according to where interest rates are. And I would say that very few people knows about it. I would say that it would be very good if people knew more about it and would understand it, because they would make way less mistakes, and there will be way less extreme times that like such it's been in the past few years where it doesn't really make any sense. Valuations are high, interest rates are starting to rise, and like people don't understand what's going on. But that's as simple as that. Is interest rate is high, which cost higher now to buy a house, which is, and everything else is high, which is why people are a bit more struggling than they used to. That's it. So if you like that video, please let me know, and if you want to talk about any other subject or anything that you want to know, then let me know. I'll be happy to give it a go. Thank you.